You say that what has been missing in the market so far, and I think a lot of people would agree with you, is euphoria, and that we are on the cusp of that. What tells you that euphoria is building, and then play that through for what it could mean not once the euphoria breaks?
So there are a number of things to indicate that investors are getting to that euphoric moment. They're not there yet, Tyler, but they're on their way. So S&P 500 futures positioning is the strongest it's been since 2013. Equity flows into exchange-traded funds so far this year, $45 billion. I look at the put-call ratio, and it continues to signal that investors are very bullish from that standpoint. If I look at the AAII sentiment survey, bearishness is very low, way below historical levels. I look at all those things, and it signals that despite the risk, despite coronavirus, markets keep touching all-time highs.
So it is on the cusp of what you would describe as a melt-up, and then we'll come back to the idea of what happens after melt-ups. But, Ron, let me get – so Michael points to several market internals, I guess you would call them, indicating that maybe euphoria is about to descend upon us. Do you see that? And if not, why not?
Yeah, I would parse it a little differently, though, because there are different types of euphoria. If you go back in 1987, when the stock market, melted up and then ultimately crashed, that was largely a professional experience. There were very few individual investors who were involved. If you go to 1999, the entire country was in it. It was a cocktail party conversation everywhere. Same was true for real estate in 2007-8. I think this is still largely a professional affair. A lot of individual investors have been actually continuing to drive most of their money towards fixed income, not necessarily towards equity. So you can have a euphoric moment in the markets that doesn't include the general public. You can still be overvalued. You can still be technically overbought, but it might be a different kind of event than what we've seen in the past.
Yeah, we saw, as you mentioned just last week, those huge bond inflows on pace for $1 trillion worth this year going into bonds, Michael. But let's stick with the stock market for one more moment here. Why do you think healthcare is such a compelling investment right now?
So I think the thing with healthcare that's interesting is last year it underperformed the market by about 11%. We look at the exchange-traded fund flows for the healthcare sector over the last 12 months, and about $4.7 billion has come out. So sentiment has been pretty poor from that perspective. As a result, it makes healthcare the second cheapest economic sector of the 11. Only the most hated energy is cheaper at this point. Now, here's the thing, Kelly, that's interesting is that analysts have actually been increasing both their revenue and earnings per share expectations this year for the sector. Most other sectors have been declining. So to me, that's a very favorable result. And then lastly, you get all the structural tailwinds, aging demographic, the continued R&D spend to end awful diseases, and the longer lifespans, not only here in the U.S., but kind of everywhere, should be a boon from a longer-term perspective for the healthcare sector.
Shrugging off Medicare for all and all of that kind of talk, Michael?
I think that's why they underperformed last year, Kelly, is that the political overhang is creating an opportunity between the sentiment and the fundamentals. And I think the fundamentals will win out as we get clarity on the election later this year.
Talk to us about healthcare, Ron. What do you think?
I mean, I don't think it matters who wins the presidency. It's very unlikely that the general public is interested, or at least 150 million people who have private health insurance through their employers are interested in giving up that option. And so we've seen that, there might be some structural change to different healthcare programs, whether it's a public option, but Medicare for all seems DOA. And so as a consequence, it would be one reason why healthcare would come back if it's going to come back. And again, assuming that the fundamentals support it and people play catch up in that sector.
Real quickly, on that point you're making about people pouring into bonds, Ron, does that have larger implications? Do you view it as, a missed opportunity to get into the stock market, or do people just think that because it's not as if valuations there are so compelling.
No, with 160 on the 10-year, it's not exactly like we're near the highs and you'd want to be, taking some chances on bonds. I think it goes back to something we've been talking about for almost a year and a half now, is you have to buy quality, whatever it is you buy, and you can't put a speculative lens on this market. So the risk, farther out you go on the risk horizon, the more chances you're taking. We've seen expanding junk bond spreads. We've seen a break in some of the credit indices. And so I'd be a little careful there, but it doesn't necessarily suggest that you should rush into overvalued stocks either, because you're kind of playing with the same degree of fire.